Hey everybody, my name is Kyle Nada and I am not your average finance guy. Let's talk a little bit about gambling today. All right, 401k stock market versus IBC cash value. I get a little excited sometimes. I get a little gambling going on, go play a little blackjack. I've done some craps before, don't really know what I'm doing too much, but I like it from time to time. And I'll tell you what, I still play around in the stock market a little bit from time to time. I don't have a lot of money in there, but I do. I enjoy the chase. And so the back behind me here, you can see the 401k stock market graph. I somewhat this is kind of what the S&P 500, the spider index, the SPY looks like. So that's the S&P 500 is the 500 biggest companies, and you kind of buying shares of all of them. And that is my rendition of kind of what the graph looks like over the past year. Okay, as you can see, it kind of, it sawtooths its way and it goes all the way to the peak, and then man, as of late, bang, it's been crashing. There's a couple of jumps here, and I'm recording this on April 4th, and there's been, the Trump tariffs just took place, and there's been 2 days of a shellacking. So this thing is tanking fast. But nobody knows what tomorrow is going to bring. Nobody knows, what we can all see what happened, but we don't know what is going to happen. Okay, so what's your personality type? Do you like to take the gamble of the sawtooth? You're going up, you're going up, you're going up, and bang, goes down. Now I'm sure at some point it's gonna keep on, sawing its way back up, but it seems like it takes 9 months to just chip, 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 get to where it has to get, and then like you see here, in 2 months it just bang, the bottom falls out, and at some point we'll find the bottom. Maybe we're there today, I don't know, but at some point we'll find the bottom, and I'm sure we'll claw our way back. Like everyone says, if you look at the long run, the stock market makes, you hear numbers from 8% to 12%, however you want to look at it, but no one knows what tomorrow's going to bring. If you don't like all that ups and downs, the infinite banking policy cash value is guaranteed. As time goes on, your cash value goes up. End of story, period. Now, it didn't go boom, it didn't go straight up, it didn't go up at the same amount that the stock market did, but it never went down. It never went down. Okay, and it will never go down. It's contractually obligated that it goes up. You're under contract. Whatever I think it's like a 4%, and then if and when there are dividends on top of that, that it just keeps on going up a little bit more. So that that line I drew flat. I drew it straight. It does fluctuate a little bit. It's how much does it go up? Okay, I guess see it the other way. It goes up a little bit. It will never go down the year after year. So last year we had 6.64% is the how that is going up. All right, so it never goes down. End of story. So with the IBC cash value, now you do with that, you're not taking your money out. Okay, over here, if you're in retirement and you need to go buy milk and you're out of money and you have to take your next draw from your 401k, where you take, if you're taking it up there when it's at $600 a share, and you sell one, or say you sell 10 shares and you get $6,000. All right, sell 10 shares up there, you get $6,000. Sell 10 shares down here, you get $5,000. Obviously we want an extra $1,000 by selling at the top. Okay, you're at the mercy of the market depending on where you get. What if you've only got 100 shares and you have to sell 10 because you need $6,000? Well, down here, guess what? How many are you selling? You got to sell more than 10 to get your $6,000. All right, you got to sell 12. So now how many shares you have goes down and down and down. And that's one of the reasons why early on, when I first got out of college and I took a good job, my dad told me, if you put 15% in your 401k, you'll retire a rich man. I'm like, cool, all right, I will do it. I didn't know anything about any of this stuff, so I slammed 15% in there. And then after a while, I actually got to look in, and you could put more than 15%. You could put up to I don't even remember what it was, 20 some odd $1,000 a year. I was single, living by myself, making decent money. I maxed it out. And as I did that, I did it for probably a year or two. I maxed that out. I maxed out a Roth IRA. I'm like, I am going to be cooking in retirement. I got to crunching the numbers like, wait, I can never touch this money until like what, 65? This is not going to help me retire early. I don't want to work until I'm 65. I want to have my money work for me. And okay, great, you're 65. And what can you do when you're 65? I mean, I'd love to go up to the mountains, go skiing. I like to be active. I like to do things. Can you do that when you're 65? I don't know. Maybe if you keep yourself in shape, but I want to enjoy that money when I'm younger. So what I kind of did is I kind of got away from this model, and I still do, you know, a 401k match. I would suggest if your employer does a match of any kind, I would say do that. So a lot of people, the place where I worked was 6%. The match 100% of 6%. So that's 100% of your money. Do that. I would say do that. So right, just like that, you made 100% of your money. Now, if they don't match at all, now you're looking at some different things. So at that point, you may want to think about something different. Maybe Roth IRA, maybe you want to get into an infinite banking policy. But at that, when I realized that, that's when I kind of made the shift, and I started looking at real estate. So if I back this off, instead of putting 20 grand a year into this chaos, instead I pulled back and I put my 6% in, got that double, and the rest of it I put, and I started to save up I would buy real estate. Now what I would do is I put it in a savings account, and then I did that for a couple years, and then I was like, oh, wait, I figured the whole IBC out. Now what I did is I put everything in here, everything I would put in savings, I put in here, and now I have steady growth, and I can take a loan against that at any time. So anytime I want, I take a loan against that. It doesn't affect my cash value. My cash value always goes up year after year. Even though if I borrow against it, it's still in there. It's still compounding. It's at right now 6% and it's compounding interest. So it's day by day. Every day it's in there. It puts a little bit of interest. That new balance. The day after that, it calculates the interest on that. So it's always growing, growing, growing. What Einstein said, that compound interest is the eighth wonder of the world. Those who understand it earn it. Those who don't pay it. So think about that. IBC, the insurance companies that we use, they're liquid. They've been in business over 100 years, some of them pushing 200 years. These are mutually owned companies. So there are stock companies and there are mutual companies. Stock companies are the big boys that everyone knows about. You can pull up on the stock exchange and you can buy a share of stock, and you can ride the wave of whatever that company's doing, whatever their shares are doing. Or you can have a mutual company where you are an owner. They're not beholden to stock or to stock prices and stockholders. They're beholden to us that actually have policies. So we're the owners. Since we're the owners, we are entitled to dividends, which help make that go up every year. All right. So there is a contractual minimum that they have to pay, around 4%, maybe 3 or 4% now. But then after that is how well did the company do? If the company did well, they pay dividends to the owners, just like any other business. And so that adds a couple, we're at 6.6, I think. So almost doubled it. So that's great. So that's where we're at with the 401k, the IBC cash value is just kind of explaining both of these and what's your risk tolerance. Now a 401k, you don't have to put it into the stock market. Most of everything 401k I've ever seen is into the stock market or mutual funds. There are bonds available, which is, might as well draw a straight line. Those are even kind of dipping on get bonds at all. I don't think they're very good, but that's my opinion. If you're into bonds, go for it. But especially if you're into your retirement years, maybe you got to get into bonds because it's more steady cash flow. That's what everyone says. You need to get out of the volatility of the stock market because you're getting close to retirement. You need to control that money. Well, what if you had an IBC policy? I can tell you pretty much where it's going to be in 20 years from now. Now, I'm not going to get the dividends just right. That's going to tweak a little bit, but I'm going to be a lot closer instead of saying I'm going to do this for 20 years and it should be about 10% higher than where it is now. Well, right now or there or what? Where are we at? I mean, if you want, this is a year's worth right here. If you want to ride this roller coaster, and hopefully, it's been going up, hopefully it keeps going up. But where do you want to be? Or do you want to be over here? You want to know exactly where you're going to be at retirement within a much smaller target. I guarantee you can hit a target a lot better on that chart than you can on this chart. Okay, so just some things to think about. And if you ever got any questions on this, please hit me up. I love this kind of stuff. So let me know. I'd be glad to help. And good luck, everybody. Let's get wealthy together.